power of compound interest. A tale of Warren Buffett. In the world of investing, few concepts are as powerful and transformative as compound interest. Imagine a small snowball rolling down a hill. At first, it's just a tiny ball of snow, but as it gathers more snow, it grows larger and larger, eventually becoming a massive snow boulder. This metaphor perfectly illustrates the concept of compound interest, where your money can grow exponentially over time, given the right conditions. Let's take a moment to explore this through the lens of one of the most successful investors in history, Warren Buffett. Known as the Oracle of Omaha, Buffett has built his fortune not just through smart stock picking, but also through the incredible power of compound interest. Buffett began investing at a young age, and one of his earliest investments was in a pinball machine. He reinvested the profits, and soon, he was running multiple machines across various locations. This initial success, though modest, laid the groundwork for what was to come. Buffett understood that the secret to wealth wasn't merely about making money, it was about letting that money work for him over time. Consider this. If you were to invest $1,000 at an annual interest rate of 8% compounded yearly after 30 years, you would have approximately $10,062. But what if that investment grew at 10% instead? You'd end up with about $17,449. This illustrates how even a small increase in the rate of return can lead to significant differences in your final amount. Buffett has often said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." Buffett's investment strategy has always involved long-term thinking. He famously invested in Coca-Cola in 1988, a decision that seemed risky at the time. However, he recognized the power of this brand and its potential for growth. As Coca-Cola continued to expand globally, Buffett's investment compounded over decades, leading to billions in returns. The longer you allow your investments to compound, the greater the potential for your wealth to grow. Just like that snowball gaining momentum down the hill, be starting early and allowing your investments to grow over time, you can harness the extraordinary power of compound interest. So whether you're just starting your investment journey or are already on your way, remember, the earlier you start, the more you can benefit from the magic of compounding. Compound interest in action savings accounts. When you deposit money in a savings account, the interest earned gets added to the principal amount, and in subsequent periods, interest is calculated on the new total retirement accounts. For instance, if an individual contributes $200 monthly to a retirement account with an annual return of 7% after 30 years, they could accumulate over $400,000, illustrating the power of compounding. The Rule of 72. The Rule of 72 is a simple way to estimate how long it will take for an investment to double given a fixed annual rate of return. By dividing 72 by the annual interest rate, you get the approximate number of years required for doubling. For example, at a 6% interest rate, it would take about 12 years to double your investment. The compound effect in daily life. Small actions lead to big results. The compound effect applies not only to financial investments, but also to personal habits and daily choices. Small, positive actions, when repeated over time, can lead to significant changes. The compound effect is a powerful principle that influences many aspects of life. By understanding and applying this concept, individuals can make informed choices in their investments, health, education, and relationships. Embracing the power of small, consistent actions can lead to extraordinary outcomes over time. Common mistakes in leveraging compound interest. When trying to leverage compound interest, people often make several common mistakes that can hinder their ability to maximize their returns. Here are some of the most frequent missteps. Starting too late. Many individuals underestimate the importance of starting to invest early. The earlier you start investing, the more time your money has to grow through compounding. Delaying investment can significantly reduce the total amount accumulated over time, ignoring the power of consistency. Some people invest a lump sum but fail to contribute regularly. Consistent contributions, even if they are small, can enhance the compounding effect over time. Additionally, setting up automatic contributions helps maintain consistency. Not reinvesting earnings. Failing to reinvest dividends, interest, or other earnings can limit the growth potential of an investment. By not reinvesting, individuals miss out on the benefits of earning returns on their returns. Choosing the wrong investment vehicles. Not all investment vehicles offer the same potential for compounding. Some may have high fees, low returns, or unfavorable tax treatments. It's essential to select investments that align with your long-term growth goals. Timing the market. Many investors attempt to time the market by buying low and selling high. This strategy can lead to missed opportunities as it is challenging to predict market movements. A more effective approach is to invest consistently over time, regardless of market conditions. Focusing too much on short-term gains. Investors may become overly focused on short-term performance, leading to impulsive decisions. Compounding requires a long-term perspective, and reacting to short-term market fluctuations can disrupt the compounding process. Underestimating inflation. Some individuals fail to account for inflation when considering their investment returns. If the rate of return does not exceed inflation, the real value of their investments can diminish over time, negating the benefits of compounding. Neglecting to diversify investments. Concentrating investments in a few assets can increase risk and reduce potential returns. Diversifying across various asset classes helps manage risk and can enhance overall returns through compounding. Paying high fees, high management fees, and commissions can eat into investment returns. Investors often overlook the impact of fees on long-term growth. Opting for low-cost investment options, such as index funds or ETFs, can help maximize compounding effects. Lack of a clear investment strategy. Without a clear investment strategy and specific financial goals, individuals may make arbitrary investment decisions. Having a well-defined plan can help guide investment choices and ensure that they align with long-term compounding objectives. To effectively leverage compound interest, it's crucial to start early, invest consistently, reinvest earnings, choose the right investment vehicles, and maintain a long-term perspective. By avoiding these common mistakes, individuals can maximize the benefits of compound interest and work towards achieving their financial goals. Your support means a lot to me. Please remember to like and subscribe. I would love to hear your thoughts. Please leave a comment below.